So we're wrapping up a pretty busy week in the market. The highlight, of course, being the FOMC meeting on Wednesday, where the Federal Reserve raised their benchmark rate by 75 basis points, a move that was widely expected. Although there had been a little bit more of a dovish expectation priced in to the market heading into the meeting, I think Powell did a pretty good job in this one. I've been a long-term critic, but he remained steadfast and I'm paraphrasing, essentially said, we're going to keep raising rates until we feel that inflation is under control. I'm still in the camp of a 50 basis point hike in December and then a series of 25s. But it's going to depend on two data points. It's going to depend on employment and new inflation data as it comes in. If employment conditions remain tight, it's more fuel for the Fed to keep hiking rates. I think the market now needs to move away from a how fast are rates rising to a how high and how long. The market just needs to adapt to this new environment. I think one thing Powell's speech did was serve to give a little bit better forward guidance. And to me, that's a vol dampening situation. I don't foresee a situation where rates skyrocket from here, nor do I see an environment where rates fall dramatically, barring some kind of existential event. I think for 10-year notes, I think we're firmly between a 3.85 and a 4.5% range. Now, for a trader like me, that's a pretty wide range. But if you're an issuer, it at least gives you some certainty to the market, and you could help time your issuance better. Cooler heads have prevailed, like we've been expecting them to, and I don't see borrowing rates staying this high. I think if anything, I think rates are probably skewed to the lower end in terms of where new issues will come out. And it's not because I think rates are falling. I think part of the premium right now built into the funding market is the uncertainty premium. So for instance, a yield that may come at 8% now, over the next few months could fall by 50 basis points. The shock and awe has come out of the market, and that's very important to get back to more normal functioning markets. But I think it's important when new inflation data comes out that the market understands that inflation, which is just the rate of change, can actually start to fall, but yet prices remain elevated. So the initial reaction to any lower print in inflation will be for a stock market rally and a bond market rally. And I think participants have to be careful about that. In my opinion, rates have to stay higher for longer. I think better funding conditions will occur over the next few months. Just the market has to adapt to this new environment. You see Walmart now advertising this holiday season that they're going to revert back to 2021 prices. Inventories are high. So I wouldn't call it deflationary. I refer to it more as disinflationary environment. So where do rates go? I think we're range bound. I think volatility comes down. And I think it's a more favorable environment for issuers. You're going to start to see liquidity come back. Your non-member deposits, the CD businesses that we're involved in, you start to see more liquid transactions, easier transactions to get done. I'm actually optimistic over the next 3 months. A lot of the uncertainty has been taken out. Cooler heads have prevailed. And I think we're going to get back to more normal functioning markets. I think some discounts do exist, specifically in the belly of the curve, where you can get lower rated paper at an 8% coupon, whereas in the higher rated, you have to move out to 30 years to get similar equivalent yields. So for investors who are paying attention, there are bargains to be had. I favor 3 to the shorter end of part of the curve, and that's it.